It's amazing when you realise that private investors who consistently lose money in the stock market do so because they make two basic mistakes. And the surprising thing is, it's not particularly about the companies they invest into, it's about how they manage these investments, otherwise known as portfolio management. In this video, I'll explain what these mistakes are and how to avoid them. But, in short, if you only focus on reward when you make an investment, that is, how much money you're hoping to make, you are likely to lose money. That's because investing is about risk management. If you do not have a strategy to manage risk, you risk losing your money. In summary, you'll become a loser. The biggest mistake to avoid, you realise after a while, what it is, right? So this is about what, when, how. This is the how part, portfolio management. One of the most important parts about investing, and I do say in the book, it's very rarely referred to. But it's like, if you don't have portfolio management at all, it is like, having a house with no roof on it. You can have nice little expensive stuff inside, it'll all get ruined. The biggest mistake investors make is...
Now, pay attention, please.
...going too big on an investment and holding them when they become a loser.
I'm a loser, baby, so why don't you kill me?
And I love this quote, and this quote is at the end of the book.
But it ain't about how hard you hit. It's about how hard you can get hit and keep moving forward. How much you can take and keep moving forward. That's how winning is done.
It doesn't matter how big your punch is. If you have no defense, you will get knocked out. Recently, Anthony Joshua fought Francis Ngannou, who held a record for the hardest hitting punch. Ngannou held this record since 2017. Huge punch, apparently. Anthony Joshua dominated the bout, knocking down Ngannou with a straight right hand the first round. Ngannou beat the count, but was floored again in the second round. He rose to his feet, Joshua again, and knocked him out afterwards. And he had the biggest punch in the world, pretty much, Ngannou, is saying, right? This is the same with investing. Successful investing is about avoiding big bits. Okay, it's not about big wins, it's about avoiding big hits first and foremost. You don't have to get massive wins as long as you avoid the big hits. It doesn't matter how many winners you pick. If you hold more losers, or your biggest holding is a loser, you will not make money. So make sure your losses stay small. How do you know which stock will be a loser? You don't. Until they start losing. So when you make, and I often say this, the most emotional investment you ever make is the first investment in a new company. Because you assume it's a winner. Oh, yes. Otherwise, you wouldn't be investing in it. Of course it's a winner. It's in your head. This is going to be a winner. So we need loads of money. But some will turn into losers. It's inevitable. Don't ever think they won't. Of course, you always think you only invest in a company because you think it's going to be a winner. That's why you're hardwired to go a little too big on it. So to avoid being over-leveraged losers, do not let them take up too much of your portfolio. You're never going to be 100% sure which company will be a winner until they start winning. It's the same as trying to guess the winning horse before a race starts. Imagine that before a race starts at the Grand National. You've got like 30, 40 horses there. If someone said to you, to pick a horse before the race starts, the winning horse, is it easier to pick the winning horse before the race starts or after most of the race has been run? After the race is underway and it's been going for a little bit, you can spot the winner. So it's like having a portfolio of stocks. You don't know which one is going to do absolutely well. You don't know which one is going to do badly. You suspect some will do better than others because they're growing more, balance sheet's better. But you have surprise winners and surprise losers. It'll always happen. Do not decide you're a winner before you invest. Otherwise, you will go too big on it. And like horse racing, with investing, you can pick the winner when the race is running. And in fact, it's a very long race. It can be for years. That's why it's important to start small. Let the winners and losers reveal themselves, because they will. You know when you've got a winner. It just happens. And a lot of the time, it may not be because it's a better growth of value. Of course, good stocks with growth of value do well. But sometimes it's about shares in issue. It's about lack of sellers and all that stuff, and just more buying momentum. And you have no control over that, net supply and demand of a stock. So some stocks already shoot up to momentum because there's a tight hold in the stock. So you don't want to put all your eggs on one stock and then miss out on another stock. So if they turn out to be a loser, make sure you cut before it becomes too big. If it turns out to be a winner, increase your exposure. Stop losses are like insurance policies. You don't want to pay for insurance, but it's there to protect you when an investment goes wrong. And they will go wrong. This is the thing that stops people making money. And yet very few people, especially starting out, the problem is they don't think they're going to have a loser when they invest. Just be objective about it. It may be a loser. I want to take an insurance policy against that happening. That will prevent me from having big losses, and that will make them perform better. I mean, and I said this even in the bear market, I held companies. I didn't have some stop losses in. I had an excellent strategy for the bull market, which was an unusual environment, the last bull market. Money cost nothing. Interest rates were at rock bottom. I think the lowest they've ever been for the longest period of time ever. So we're probably never going back to that environment. And people were betting on companies that could just raise money, all about the story. It's not going to be like that anymore. It's going to be, decent companies. And in the bear market, like I said, going back to that, if someone said to me, would you have taken a 20% loss on this company that maybe went down by 90% or 80%? Yes, I would have, absolutely. And that's the things that drags your portfolio down, just holding on to those big losses. And by the way, also, if you get a winner, right, the stop losses are not there to take a small profit, only to miss out on a big profit. So be careful when you start getting into a profit or start moving in the right direction, okay? So initial investments, set them so the maximum you'll lose on a new investment is defined. That's your risk management. Investing is all about managing your risk, because when you risk capital, that's your money. At the start, that's all you're doing is risking it. There's no reward. You're just risking your capital. So let's say you put, between 1 and 3%, could be 1 and 5%, whatever you're happy with, of your total portfolio value. So let's say you got 100 grand portfolio. I always say that. I know some of you haven't got that. Some of you may have more. I don't know. But it's easy round figure. So let's say you say, 3% of that, and I put into the stock as 3 grand, okay? And you're only going to lose 20% of that, okay? If it goes wrong, it's an insurance policy. You don't intend to go wrong, but it may go wrong. You don't want to lose the entire 3 grand, because now you've got 7 grand. So that's just an insurance policy. Once the company rises by 20%, move it up to your buy price, risk-free. So once you get that risk-free investment, you can sit there and relax again. I'm never going to lose money on this. And when you get into profit, you can move the stuff up. Don't move up too aggressively, like I said. You don't want to be taking a small profit and miss out on a bigger long-term profit. Because some of these companies, you never know. You could be holding a JD Sports, like 13,000%. If you'd have half that, it would really transform your portfolio. You only need one of those in your lifetime. So you don't want to take I made 20% on that, and then miss out on 13,000% or whatever. So as long as you get risk-free, then you can relax a bit. It's the first 20%, that's risk-free. And if you do that, your losers get big, and you're not taking small early profits on potential winners. Those are the two things that private investors do. You get too big, the loss becomes too big, and they take profit early on the winners. If you can sort those two mistakes out, you'll become an investing genius.